Hi guys. Today we're gonna do Wise Wealth again. Uh, we went over stocks, growth stocks, dividend stocks, and value investing. And the last thing we did was value investing, which is when you take the intrinsic value of a company and compare it. But essentially, I'm gonna go over this video what valuations are. So essentially, what a valuation is I'll just type it. I'll write it out. Is when you use an analytical process to determine the projected value of a company or asset. And usually this is a quantitative process. I can't spell. Usually it's a quantitative process, and or you can value a company by comparing it to other companies. I'll go over that in another video. Which is called the comparable company analysis or comps or CCA, whatever you want to call it. And then usually, this is big, usually, actually not usually, always, um, valuations are subjective, meaning meaning by using these estimates and stuff, you have to assume about the company. It's not exact. And um, so there's multiple models they could use. One is an absolute valuation model, and this includes finding the intrinsic value of an investment, um, focuses on things like dividends, cash flow, and or like the growth rate of the company. Usually, when you use the absolute valuation model, you're not comparing it or you're not using other companies to value the target company. Now, the other model you could use is a relative valuation model. Relative meaning you compare the company to other companies. So compares. So you compare the company being researched to companies that are in like a similar field or a similar size or have similar products, similar location, stuff like that. And I'll make a separate video on this comparable company analysis. And usually this involves calculating ratios. Like PE ratio, really any of the ratios to be honest with you. Or sorry, not ratios, multiples, which is essentially the same thing, but it's you apply the multiple to evaluation. I'll make, like I said, I'll make another video on that. Now, these are the two models. The actual methods, there's three that the main common ones. the three common methods to value a company. You have the discounted cash flow model or method, whatever you want to call it, or DCF. Then you have the precedent transact, or actually, I'll do it in order, which I'm going to make the videos. Then you have a comparable company analysis, or you could call those comps or CCAs. And then you have a precedent transactions method. And essentially, what this is it's just different ways to calculate the value of a company. Like I said, I'll make a video on DCF. I'll make a video on comps. And I'll make a video on precedent transactions coming in the near future. But I just want to get the valuation video out now, so you guys have like a baseline. The other thing with valuations is earnings can affect valuations, um, like pretty greatly. So, for instance, EPS indicates the company profit or earnings per share, which is essentially the earnings available to common shareholders divided by the number of outstanding shares. Um, I'll write that down. Common. So earnings available to common shareholders divided by number of outstanding common stock. And basically the idea here is a greater EPS essentially means how valuable a share, like the EPS is how valuable a share is. So greater EPS means that the share will be more valuable. Another earning metric used here is the PE ratio, like I was talking about earlier, which is essentially the market price per share divided by earnings per share. And what this does is it calculates how expensive the stock is relative to earnings produced per share. And then I'm sure most of you guys have probably heard of this one. Earnings before interest, tax, depreciation, this one's a long one, and amortization. Actually, I think it's all one M, but whatever. And this is commonly known as EBITDA. I don't know how to pronounce it. It's just, I don't know how else to pronounce it. EBITDA. But anyway, um, it's used as a valuation metric since it removes the external accounting factors. And essentially this focuses on the pure operating performance of the business. If you guys want another video on EBITDA, then just say in the comments or something, and I'll make another video on it. But essentially, the main idea of this video, the valuation video, is that a valuation determines the company's worth or what it should be valued at on like what should be valued at on paper. Company asset, project, whatever you want to call it. And it gives buyers a idea of how much they should pay for an asset and how much the seller should sell for. So it gives the buyers get an idea of, again, how much they should buy it for, and how much the seller should sell for. And valuations, extremely important in mergers and acquisitions. And why is this? So essentially what mergers and acquisitions is when like a company merges or buys another company. And why is it important? Because you got to know how much you should buy the company for and how much you should sell the company for. So yeah, the main idea with valuations is it essentially just gives you an idea of how much a company's worth and how much a fair price to pay for it is. So yeah, thank you for watching. I'm gonna make 3 more videos on the models, the discounted cash flow model or method, the comparable company analysis, and the precedent transactions. So those will be coming in the near future. But yeah, thank you for watching this valuation video.